Hey guys, welcome to our special series, Let's Understand Passives with Mirae Asset. And today we're going to talk about something which I can only describe as a big shared love between Umesh and me, which is smart beta investing. And Umesh, you're actually the person that got me into this whole style of investing. Very quickly, just to introduce the subject, what this does is that it puts in place certain factors and then it automates your style of investment. So in a way, it really takes the human bias out of investing, right?
Yeah, true. Actually, if I talk about investing per se, I think we have been, as an Indian investor, we have been investing since long. Started with FD and then obviously different ways of investment and then moved to now mutual funds and all that. And similarly, the passive space. So let's talk about passive first. So I think passive space सबसे पहले शुरू हुआ, and I think now we can see we have made a significant growth in passive. And with time passing, I think people started understanding the need for something which can gives you better than market returns, being within the passive space only. And I think that is where smart beta or factor investing came into picture. Now, if I talk about this space, this is not a new phenomena. This is very old phenomena. Like globally, the first smart beta fund got launched in 2003. And in India, if I'm not wrong, I think 2015 was the time when actually smart beta products got launched in India. So it's not a new phenomenon, but yeah, in last 2-3 years, we have seen that investors now started understanding that how the smart beta works, and within smart beta, what sort of factor we should look at. So as you rightly said, I think this is a something new within this investment space you can look for. And I think now what data, if I look at, more and more investors are getting into smart betas.
Yeah. Oh, absolutely. It's definitely become the hot pocket where you can find a lot of interest coming in. And like you mentioned, a lot of the products are new right now. But the good thing about smart beta is that because it's based on factors, you can go back how many ever years you want and put it to the test. So even if we have a fund which is 1 year old, I can go back 15 years and test it out. And there are a lot of factors. We'll of course talk about that in just a bit. But, if you look at any fund manager as well, they all have a style of investing, right? Someone will use a value style. Someone wants to use momentum investing. So these are all anyway styles of investing. It's just that this is an automated kind of model of looking at it.
Correct. I think look at any fund house or a fund manager or the portfolios. You will see कि हर fund manager का एक style होता है, stock selection का एक criteria होता है, and because we all know that market has different cycles. Market कभी bull phase होता है, कभी bear phase होता है. तो मार्केट के साइकिल्स है, तो अकॉर्डिंगली फंड मैनेजर का अपना एक स्टाइल होता है टू सेलेक्ट फंड्स. तो स्मार्ट बीटा एज अ थीम is being used as a strategy, is being used to select stocks in India and maybe obviously the globe also. But slowly, gradually, it is putting to the main difference between actively managed smart beta strategies or in passive is the major difference is rule. Because जब कोई fund manager stock select करता है, because their objective is to outperform the underlying benchmark. So sometimes they choose one strategy. Kabhi, depending upon market changes, sometimes you've seen that they change the strategy because their objective is to outperform.
Here you can't
change because it's purely and rule based. So whenever जब भी कोई index बनता है, that we all know that index is for perpetual. Index रहेगा तब तक रहेगा. Now if you put a smart beta on the index, means जब तक वो index रहेगा तब तक वो rule उस पे रहेगा. So it's a rule based, passively managed. Once a rule is fixed, it is there. Now investor is aware कि ये एक इंडेक्स है, इस पे ये रूल अगर चल रहा है, say for any factor for that matter, से अगर अल्फा का फैक्टर चल रहा है, तो till the life of that index वो अल्फा फैक्टर ही रहेगा उस पे. तो investor is sure. Now he and she can take his call whether they want to go for alpha or some other factor. So it is different. वही स्टाइल है, वही सब कुछ, बट थोड़ा अलग है, रूल बेस्ड है. Disciplined, I must say.
Yeah, disciplined. I agree. So anyway, you were mentioning some of the factors like alpha. So let's talk about the different ones. Alpha momentum is, of course, what has caught everyone's fancy in India of late because, we've been in a roaring bull market. So let's start with talking about that. But then we'll also talk about this, some of the others which are there. Maybe they're not as much in vogue right now, but they are worth considering in your portfolio as well. So alpha and momentum, basically, these look at, there's a small difference between them, but there's a significant difference. So alpha will look at outperformance to the index, right? It's based on Jensen's alpha, which is calculated, and then, it will be applied to the entire index, and then you can select a number of stocks. Say you can select 30 stocks or 50 stocks, whatever your index is going for. And this is a kind of trading strategy, right? So it will be rebalanced more often. It's rebalanced, I think, every quarter. Momentum is similar. So it will look at how much the movement is of the stocks. But the big distinction here for me is that market cap is considered, right? Now, because market cap is considered, what happens is that this index tends to have a large cap bias, which is not true of alpha.
Yeah, I mean, you rightly said. So just quickly, I'll just go a little back
Yeah.
and just explain key factors. We understand smart beta is something which is a rule based and which objective is to maybe outperform the plain vanilla index on which the smart beta index is being created. So it's again an index based story. But now, if you talk about smart beta, there are multiple type of smart betas. So there are maybe six, I can say, key factors which are being used. Obviously, one is alpha and momentum, and which is being talked a lot in India, and I think in a market like India where we still can see alpha is there on active side also. But on passive, if you put a alpha or a strategy like that, which always helps or which always catches the attention of investors. But apart from alpha, there are factors like value, there are factors like quality, there are factors like say dividend yield. Then there is a size factor, which is in other ways we can say equal weight also. So that's also one factor. So these are the maybe few different factors which can be used in different market cycles. So now coming back to alpha and this thing, so alpha momentum is something which is, as you rightly said, looks similar because both are the objective of both factors is similar kind of. But when you go into the actual nitty-gritties, you understand the stock selection is different. And trust me, for any factor, the stock selection is the key.
Yeah.
How you select a stock in a particular market cycle, it actually defines funds performance or its funds, how the particular fund will behave. So factor like alpha, momentum, both are good factors, not bad factors, but both have a different stock selection style. Like as you rightly said, momentum will always look for market cap. Obviously, the rebalancing is 6 months. So sometimes we have seen that particular stocks need to be changed, but you have to wait for 6 months because it's a rule based. Alpha gives you advantage of rebalancing in every quarter. So if something like if you have to, you can rebal quarter by quarter your portfolio, capture the trend. So momentum and alpha, both those factors are actually they captures the trend.
Yeah.
Trend can be both sides. So these are the factors like if there is a trend in the market and portfolio need to be rebalanced. So every quarter you get that freedom.
No, absolutely. You also mentioned value, quality. So just take us through some details because this is a question I get a lot that, okay, you are saying that quality is a factor, but how do you define quality? That can look a little bit different. So there are certain, points that we look at when selecting stocks, based on this quality factor, such as low debt, high promoter holding. But you want to add more to that?
So we call them fundamental style factors. So fundamentally means you look at ROE, you look at how much debt to equity ratio is there, EPS, how much the EPS is. So every factor will give scoring for each and every sub factors, and then on the basis of which we reach to a composite score, and on basis of that the weight is being given. So when you put these things. Before that, every factor we put another, we keep that in mind to look at the liquidity problem. Because the moment you go beyond large cap, like in a mid or a small cap, we often seen that the liquidity challenges sometimes occurs. So on all, first of all, every fund manager, they try to keep F&O as a key. Maybe stocks should be taken, but there are like in mid cap and small cap where you don't have more F&O, maybe stocks which follows which are on F&O. So those where we put differential, maybe some more factors to eliminate that risk. So that risk elimination, not completely it eliminates, but yeah, it gives us like a majority of cases where you can maybe see some casualties in terms of liquidity. Those stocks are out, and then these three filters, as I said, if I talk about quality, EPS or your ROE or your debt to equity ratio, you reach to a selection of maybe whatever desired number of stocks you look at, maybe 30, 100, whatever you want.
Okay. And that's very important just in terms of giving comfort on the names that you're investing in also. I think another thing we do is that it needs to have a listing history of 1 year. These are just eligibility criteria. We don't want very bad quality names entering the portfolio in the first place. So these are all names that eligibility criteria that are put in place so that we don't get any of these names in our portfolio.
Yeah. I mean, as I said, every factor is we have seen is these are stock agnostic factors. So the key difference here in every stock or every portfolio will be the stock selection. So that selection itself is a very robust in terms of rule already written, and index is already there. So one more thing is to understand when we say stock selection, this stock selection and portfolio rebalancing or index rebalancing, everything is being done by the index provider, which is NSC, BSC, and some other players are there. So what AMC does is we just mirror the underlying index, which is being managed by index provider. So the rules are written on the basis of that. The stock selection or rebalancing happen. We or maybe for that matter, every fund manager they keep a track that how to rebalance it so that we are in line with the underlying index, so that the tracking error or difference is minimal. So that's how we manage it.
Okay, got it. So I think we've spoken about quite a few of the factors and how they behave. Something that I think we should point out is that factors, just like sectors, are very much cyclical. We are in a phase of the market where alpha has done very well, momentum has done very well. But this does not mean that every single year it will turn these kinds of returns, right? There are market cycles, and some factors will perform better in each and every cycle. There's, of course, a way to balance that out, which I want you to explain.
Yeah, I think definitely, Pavitra, you actually highlighted a very valid point because see, risk or maybe you have to be a little careful when you invest in equities, be it active or a passive, because end of the day, investment is happening into equity side. So investors should be very careful in terms of they should look at their risk profile. They should look at their what sort of horizon they have. Now, at a cyclicity level, every factor has different cycles, like the way market has. If there is a bull cycle in the market, there are factors which will do well. But if that cycle is changed at a market level, there are high chances that those factors might not do well during that particular period. Right. So if I say, for example, alpha, momentum, these are the factors which captures a trend. If market is range bound, in those cases, we might see that those factors might not do that great. So to mitigate that risk, what investors should do is, if investor, he or she is careful and they understand the market well, they can enter or exit at the right time, keeping the cycle in mind. But which is, I believe, it's very tough for everyone. Then the second option would be investors should stay longer, because the longer period you stay, the high chances of the cycle in the market moves around again, and you get your returns. So you should be very careful what is your time horizon is, and longer the horizon is better.
Longer the horizon is better for sure. And I think that just, it'll give you a more average kind of situation, right? You will catch the ups, but you'll also see some downs. So it'll give you an average return. The other thing which a lot of people like to do is kind of play two factors together, right? So maybe you will do an alpha with a low volatility kind of index. That will also make sure that if one is not doing so well, the other will probably do a little bit better. And Umesh, the other thing that I realized, of course, after talking to you and doing a deep dive into smart beta, is that within different market caps also, factors behave quite differently, right? So value in a large cap can look quite different from value in a small cap. That's something I noticed.
So I mean, I must say one more thing. What you said is right. That multi-factor is something which is right now investors should always look at, because as I said, market has different cycles. So momentum, quality, two factors you can mix. You can combine alpha, low vol. You can combine multiple factors, and that helps you in terms of riding the cycle of that particular time. But there are drawbacks also. Drawbacks, I won't say drawback. There are few things which investors should be more careful. So investors should always keep that in mind. This cannot be smart beta funds cannot be the perfect replacement of your core portfolio, because the core portfolio is something which you look at, which you invest keeping in mind certain aspects. But the smart beta is, as I said, it is cyclical. It has different cycles. So you have to keep that also in mind. Also, investors should always look at that there are times when market is not going in favor of that particular factor. There may be chances when that particular factor is not doing that great, which the expectations were. So from that perspective, investors should be patient, should be keeping longer horizon in mind, and always should keep in mind that there will be cycles. This market has cycles because everybody said that 10 years back the index level had today index levels are different. Investor had made money. So similarly, the longer you stay in any smart beta fund, for that matter, any investment in equities, there are high chances that you might end up getting better returns than.
Yeah. Oh, absolutely. And this is also overall smart beta investing is based on the presumption that what has done well up until now will continue to do well in the future as well, right? Because we've gone back, we've looked at the data, it made sense to the team, so we invested. But this is still based on a presumption that what has done well even for 50 years will continue to do well. That may or may not play out. History does rhyme usually, at least, but that is the lowdown on what smart beta investing really is on some of these factors and how you can invest into this space too.
Thank you so much.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।